This week, silver did something it has not done since 1980. It collapsed. Not a correction, not a pullback. A full, vertical, 46-year record collapse in the middle of a war that, by every rule of markets and history, should have sent it higher. The kind of collapse that wipes out months of gains before you even get a chance to react. That is what makes this story worth your time. Not because silver is interesting, because the mechanism behind it affects everything priced in dollars, including what you hold right now. Not just that silver crashed, that it crashed for the exact reason it was supposed to soar. The asset you bought to protect yourself became the asset that needed protecting. Think about what that means. The war arrives. Every textbook says precious metals win, and instead, silver loses 45% of its value in 7 weeks. That is not a market moving against you. That is the logic of the entire trade reversing. If that does not tell you something strange is happening in the global financial system right now, nothing will. Your retirement account does not care why it happened. Your savings do not recover on their own. If you have ever held silver, thought about silver, or simply watched energy prices eat through your grocery bill and wondered what it means for your money, this is a story you need to understand. This is not abstract economics. This is the difference between your savings growing and your savings disappearing. Because what is happening to silver right now is not a silver story. It is a story about what happens to your money when a war moves inflation in one direction and rate expectations in another. It is a story about how wars move through economies in ways nobody expects, how the Federal Reserve's rate decisions reach into every corner of the market, and how a metal that sits on the intersection of geopolitics, industry, and monetary policy can get crushed by all three at the same time. The Iran war was supposed to be silver's moment. Every investor who held it through the January crash was waiting for exactly this kind of event to vindicate the trade. Wars push inflation. Inflation destroys the purchasing power of cash. And when cash looks dangerous, investors historically run to hard assets. Gold, silver, the metals that do not promise anything, they simply exist. That is the promise of a safe haven asset. It is also the promise that just got broken. And when that promise breaks, the people who feel it first are not hedge funds they repositioned in minutes. It is the people who bought and held, except that is not what happened. And the difference between what should have happened and what did happen is costing holders 45 cents on every dollar they put in. The same energy shock that lit inflation fears across every market also convinced the Federal Reserve to hold rates higher for longer. Silver got hit from both sides at once. The war gave it the fear. The war also took away the rate cuts. Right now, a short-term treasury bond yields more than silver does. That gap is exactly why money is leaving. Right now, silver is sitting at $66.93 per ounce, down 45% from its January peak. If you had put $10,000 into silver at that peak, you would have roughly $5,500 today. That is not a paper loss you can wait out. That is your money, cut nearly in half in less than 2 months. The people who bought near the top are not looking at a correction. They are looking at a catastrophe. But to understand how you get from a 46-year record high to a 45% collapse in 7 weeks, you have to go back to January. On January 1st, 2026, silver opened the year near $70 per ounce, already a remarkable level, given that the metal had spent most of the previous decade trading far below that. But $70 was just the beginning. Over the next 29 days, silver ran from $70 to $121.60, a 68.5% gain in 1 month. Your neighbor who bought silver in early January and checked his account at month end thought he had discovered something nobody else knew. To understand why it ran that far, you need to understand what silver was absorbing at the time. It was absorbing everything simultaneously. The first force was fear. Tariff uncertainty, pressure on Federal Reserve independence, geopolitical unpredictability, all of it pushed investors toward hard assets as a hedge against policy chaos. Gold briefly touched $5,600 per ounce in late January. Silver, which follows gold with more volatility in both directions, accelerated behind it. The second force was a supply scare that turned out to be partly fiction. China named the 44 companies authorized to export silver for 2 years. Traders on social media misread the document as new export restrictions. Reuters later confirmed the mischaracterization. China had actually approved 2 more exporters than the previous year. By the time that clarification arrived, the price was already moving. In a thin and volatile market, the rumor did the work of the fact. The third force was real and structural. The Silver Institute documented a record in industrial demand for 2024, 680.5 million ounces, driven by solar panels, electric vehicles, artificial intelligence data centers, and fifth-generation infrastructure. Mine supply was not keeping pace. The deficit for 2026 was projected at 67 million ounces. This was not a speculative narrative, it was arithmetic, and underneath all of it was the rate environment. The Federal Reserve had cut rates 3 consecutive times at the end of 2025. Lower rates make non-yielding assets like silver more attractive relative to bonds and cash. Money flowed in from investors who believed the rate environment had permanently shifted in silver's favor. For ordinary savers watching their bond yields shrink, silver looked like the obvious alternative. The logic was sound, the timing was lethal, so by late January, silver was carrying 4 separate tailwinds at once. Geopolitical fear, a supply scare, structural deficit fundamentals, and a rate cycle that seemed to be moving the right direction. When 4 tailwinds converge on a thin market with high leverage, the result is not a rally, it is a vertical launch. Silver climbed from $70 to $121.60 in 29 days because the market was not just buying silver. It was expressing a thesis about the entire global monetary and industrial order, and then, in 30 hours, it was over. The crash started before the news did. On January 29, 2026, silver was still trading near its highs. But beneath the surface, the structure of the market had already changed. The CME Group had quietly raised margin requirements on silver futures contracts. When that happens, every trader holding a leveraged position faces an immediate binary choice: deposit more cash or close the position. There is no third option. Most traders could not deposit more cash fast enough, so they closed positions. The first liquidations triggered stop-loss orders. The stop-losses triggered more liquidations. The liquidations triggered panic selling from traders who had nothing to do with the margin call, but watched prices collapse and did not want to be last in line. Within hours, the cascade was running on its own momentum, completely independent of any fundamental news about silver, war, or anything else in the real economy. Then came the announcement that accelerated everything. On January 30th, the news broke that President Trump had tapped Kevin Warsh as the next chair of the Federal Reserve. Warsh is known in markets as a hawk, an official who leans toward tighter monetary policy and higher rates. The implication was immediate and brutal. The rate-cutting cycle that had been powering the precious metals rally was not just pausing, it might be reversing. Every fund manager who had bought silver on the premise of falling rates now had to reconsider the entire trade in real time. If you were one of the retail investors who followed institutional money into silver, you got the same margin pressure without the hedges. The thesis that had driven the metal from $70 to $121 was cracking in front of their eyes. Silver dropped 31% from its peak, from $121 to an intraday low below $75 within 30 hours. Bloomberg described it as a record intraday decline. Multiple sources confirmed it was the worst single-day performance for silver since March of 1980. U.S. Treasury Secretary Scott Bessent attributed the move to Chinese speculative activity. That explanation satisfied nobody who had watched the mechanics play out in real time. The Shanghai Futures Exchange had also raised margin requirements and restricted certain traders from opening new positions. What happened in those 30 hours was not a single cause. It was a convergence of exchange mechanics, political shock, and a leveraged market that had run too far, too fast, on a thesis that was suddenly in question. Silver closed the week of January 31st near $85.26, a level most analysts would have considered wildly bullish just a year earlier. But the damage to the rate narrative was not repaired by the price recovery. The Warsh nomination had planted a question in every investor's mind that would not go away. What if the rate-cutting cycle that made silver attractive is actually over? And if the answer is yes, what is silver actually worth? That question became a lot harder to dismiss 6 weeks later, when a war changed everything again, but not in the direction silver needed. On March 1st, 2026, the United States and Israel began military operations against Iran. Within days, traffic through the Strait of Hormuz, through which roughly 20% of the world's oil passes, was effectively shut down. The global oil market lost a supply corridor it had depended on for decades, almost overnight. Brent crude climbed past $100 per barrel within the first week of the conflict. By the time the Federal Reserve met in March, Brent had reached $107.38, a level not seen since July of 2022. For silver, that oil price should have been a gift. The logic writes itself. Higher oil means higher inflation. Higher inflation means the Fed cuts. Lower rates make silver more attractive. War creates fear. Fear pushes money into safe havens. Silver wins twice. That was the playbook. The war threw it out. Higher oil prices create a specific kind of inflation, a supply-driven price shock that central banks cannot fight with rate cuts. Cutting rates when oil is spiking, would pour gasoline on an already burning inflation problem. The result would not be relief. It would be stagflation. So instead of cutting, the Federal Reserve held. At the March 18th meeting, the FOMC voted 11-1 to keep rates unchanged. That was the second consecutive hold. The dot plot was revised from 2 cuts in 2026 to just 1. The Federal Reserve raised its inflation forecast to 2.7%. Then the market went further than the Fed. The CME FedWatch tool moved to 0 cuts, priced in for all of 2026 after the meeting. Not 1, 0. The next expected cut moved to mid-2027, more than a year from now. Fed Chair Jerome Powell, asked about the war's implications for monetary policy, said it was too soon to know. Your savings account is not waiting for the Fed to know. Your mortgage rate is not waiting, and silver's price is not waiting. The people holding silver right now are not waiting either. They are watching it fall, week after week, with no clear floor in sight. The Fed chair does not live with the consequences of his uncertainty. You do. Right now, with rates locked and inflation running above target, silver is trapped. It pays nothing. It yields nothing. It produces no income. A non-yielding metal needs either a collapsing rate environment or a collapsing dollar to justify its price. The Iran war gave silver the fear. It took away both of the other conditions. Powell's own words captured exactly where the Fed stands. Near-term inflation expectations have risen, likely reflecting the substantial rise in oil prices. That sentence is why silver is falling. The war created the disruption. The disruption created the inflation. The inflation locked the rates. The locked rates killed the metal. Here is the part of the silver story that almost nobody is talking about. Silver is not like gold. Gold is almost purely a monetary metal. Roughly 90% of its demand comes from investment, central bank buying, and jewelry. Silver is different. 59% of total global silver demand comes from industry. The circuit boards in the device you are using right now almost certainly contain silver. It is the most electrically conductive element on Earth, which means there is no substitute for it in the applications that matter most to the next 20 years of economic growth. In 2024, industrial silver demand hit a record 680.5 million ounces, the highest the Silver Institute has ever recorded, driven by solar energy, automotive electrification, and electronics. The world consumed more silver for industrial purposes last year than in any previous year in history, and the deficit is real. The Silver Institute projects 2026 will be the 6th consecutive year in which demand exceeds supply. The projected shortfall is 67 million ounces. 6 consecutive years. The physical market is structurally tight in a way that has not been true for most commodities over this period. Under normal circumstances, these fundamentals would be a floor under the price. You cannot print silver. You cannot manufacture it in a data center. The factories that need silver to build solar panels are not going to stop ordering it because Jerome Powell held rates steady. But the silver market is not operating under normal circumstances. When financial conditions tighten, when rates go up, when credit gets expensive, when leveraged positions get liquidated, the investment demand side collapses faster than the industrial demand side can catch it. Industrial users do not buy silver futures. They do not use leverage. They do not get margin calls. But investors do. And when investors flee, they do not leave slowly. What you are watching right now is the investment demand leg being kicked out from underneath the price, while the industrial fundamentals remain intact underneath. The solar panels are still being ordered, the electric vehicles are still being built, the data centers are still expanding. None of that stopped when Brent crude hit $107 per barrel. The industrial floor is there. The question is what price it actually holds at when financial conditions are this unfavorable and rate expectations have been pushed back by more than a year. If that floor breaks, there is no obvious next support level. The people who will feel it first are not the institutions they have already repositioned. It is the retail holders who bought the January narrative that have nowhere to go. $66.93 as of last Thursday suggests the market does not yet know the answer to that question. And neither does anyone else. Here is where silver actually is right now. On March 6th, 2026, silver traded at $83.48. On March 17th, it dropped to $80.90. On March 19th, the day after the Federal Reserve concluded its meeting, silver closed at $66.93. That is not a gradual decline. That is an accelerating slide 12% in 2 weeks, following a 45% collapse from the January peak. The FOMC held rates for the second consecutive meeting. The median committee projection was revised to 1 cut for 2026, half of what markets had expected before the Iran conflict began. And when Jerome Powell said he could not yet assess the full impact of the war, the market heard something specific. The uncertainty premium is not going away, and neither are elevated rates. After the press conference, CME FedWatch moved to zero cuts for all of 2026. The next expected cut moved to mid-2027. That is more than a year from now. For silver, that timeline is a sentence. Every month rates stay elevated is another month silver has to compete against interest-bearing assets without offering any yield. Every inflation print driven by oil pushes the rate cut horizon further out. Every day the Strait of Hormuz stays disrupted keeps energy prices elevated. Silver is caught in a loop with no obvious exit. And here's the thing that sits at the center of all of it. The war created the conditions that are crushing the metal that should be benefiting from the war. That is not a coincidence. That is a structural feature of how a supply-driven energy shock travels through the global financial system. It does not help non-yielding assets. It suffocates them. Silver entered 2026 with 4 tailwinds. It now has headwinds where 3 of the 4 used to be. The safe haven fear remains, but the rate environment moved against it. The leverage unwind damaged confidence. And the market is now trying to find what silver is actually worth when the investment thesis has been partially broken, but the industrial fundamentals remain fully intact. Nobody has a clean answer to that question yet. The Silver Institute's structural deficit does not care what Jerome Powell says. The solar panel manufacturers and electric vehicle producers ordering silver right now do not cancel those orders because of the dot plot. The deficit of 67 million ounces will happen regardless of where the federal funds rate sits. If the rate pressure outweighs the industrial floor, silver has further to fall. There is no automatic stabilizer waiting underneath. What is unresolved, what the market is actively pricing in real time, is whether the industrial floor will be high enough to absorb the weight of a rate environment that has turned hostile. A leveraged investor base that got badly burned in January, and a war that shows no sign of ending. Silver did not fall because the world became less dangerous. It fell because the world became dangerous in exactly the wrong way. Before you close this video, there is something worth understanding about what this mechanism means for the money you already have. This is not investment advice. What follows is factual context about how these forces have historically behaved, so you can make your own informed decisions. The first principle: supply-driven inflation and demand-driven inflation are not the same thing. When the Federal Reserve raises rates to fight demand inflation, it slows the economy down. That typically hurts equities and growth assets. But supply-driven inflation, the kind created by an oil shock, is different. The economy slows because the cost of producing everything goes up, not because people are spending too much. According to Federal Reserve research, supply shocks tend to compress corporate margins without the Fed being able to do much about it. Historical data from the 1970s OPEC shocks shows real equity returns were sharply negative, while inflation-linked instruments held value better. The second principle: when a central bank is frozen, unable to cut because of inflation, unable to hike because of growth concerns, short-duration assets historically outperform long-duration ones. According to BIS research on monetary policy uncertainty, prolonged rate holds following supply shocks have consistently favored shorter fixed-income maturities. Long-duration bonds lose the most when yields stay elevated and uncertain. Short-duration instruments reprice faster and carry less duration risk. The third principle applies specifically to silver and gold. IMF historical analysis of precious metals during supply shock episodes shows that gold tends to hold better than silver during rate hold periods, because gold's demand profile is more purely monetary. Silver, with its heavy industrial component, tends to underperform gold specifically when rate expectations deteriorate. That is the dynamic playing out right now, in real time. None of this tells you what to do. It tells you what the mechanism is. What question are you asking yourself about the money you have today?